chapter. In this chapter, we started with how much to capitalize to a property, plant, and equipment asset, right? What do we debit to an asset? And so we talked about land, which does not depreciate because dirt is dirt. And then land improvements, things that attach. Like, what is a land improvement? Give me a suggestion. A fence.
Light post.
A lighting, okay, permanent lighting.
Sprinkler system.
Sprinkler system, sewage system, those kind of things, right? Parking lot, all right. Land improvements do wear out. You've been in parking lots that, you know, they deserve the property. You know they wear out. You've got to maintain them and they still wear out, right? And they have to repave, okay. So land improvements, building, machinery, equipment, furniture, and fixtures, all costs necessary to get it ready for its intended use. So until we start using that, whatever we spend is capitalized, debit the asset. Then we talked about the lump sum purchase, and that was the chart. It had 3 columns. And we did the first column, which was fair market value. Then we did either fractions or percentages. Okay, we did division to make sure we have 100%. And then we put the amount that we paid for the shrink wrap deal, and then we multiplied the percentage or fraction times that amount to get the amount of allocated cost. Okay, then we talked about capital expenditures. So when do we capitalize a major repair or something, a betterment? Then we capitalize it. Or a revenue expenditure, which means it's a repair maintenance expense, okay? Or tires on a car that you just have to replace often. And if you drive a Mercedes like mine, it's more often than you should. And then we began talking about depreciation. What it's not, it is not a change in fair market value. And what it is, an expiration of usefulness, and it's a systematic and rational system of taking the amount of what we pay, the capitalized cost, minus what we plan to have at the end, the salvage value, also called residual value, also called scrap value, and putting that into every income statement that will use that asset. Because property and plant and equipment have 3 characteristics. Number 1,
Tangible.
you can touch them
They last more than a year.
more than a year.
It's used.
And you use them. You don't have like inventory to resell, okay? You can't say that land is property, plant, and equipment because a land developer, that's inventory. And when there was somebody, Florida Southern, they had an old North Carolina cabin, and they left that in their will to Florida Southern College. Now, it's not like you can, in your 10 minutes between classes, dash up there and take a class in that cabin. So that was not part of the property, plant, and equipment at Florida Southern. It was an investment. So land can be investment, it can be inventory. So you can't make a list of what is, you see what I'm saying? You look at its function. Are you using it? Does it have longer than a year life? And can you touch it? Okay? The function of it all. All right, so, and then we said that now that we've decided how much to capitalize, we know that it will wear out and this usefulness needs to be spread. So how do we compute that? And you are responsible for 3 methods, and we've gone over 2. The first one is straight line. The formula for that is cost minus salvage, which is called your depreciable base, the number of dollars we want to put into those income statements, divided by useful life, okay? And that is the same amount every period. If the useful life is years, that's the annual depreciation. If we don't have it the whole year, then we have a fraction for the first year, and a fraction if it's a 5-year life for the 6th year, the rest of that year, okay?
What did you say the cost line salvage is called?
Depreciable base. The amount of dollars we want to depreciate. And then the rationale is, if you're going to use it for 5 years, then put an equal amount into every one of the 5 years. That's logical. That's its rationale. So the 3 things you need to know about each of the 3 methods: the formula, how to compute it, and then thirdly, why is it logical? Okay. And logical is equal amounts in every period. The second one was called units of production. The units of production has 2 steps. In the first step, it's the same numerator, cost minus salvage or cost minus residual, right? or scrap, divided by, but it was not useful life because it's, in this one, depreciation is not seen as a function of time, but a function of use. And so we have to decide how we're going to measure its used upness. Okay? How are we going to measure how we use it? For a car, we said mileage. For a copy machine, we said copies. For a machine, it could be hours. For an airplane, engine really is supposed to be hours, but with the airplane one that we did was in miles flown. Okay? Could do it either way. Those are both units of production, miles on an airplane, or how many hours the engine has flown. Either one would be an acceptable base. And so we do the estimated, so it's an estimate, total number of miles or hours or copies, right? And that was step one, which gave us depreciation per unit. And then the second computation, and that stays the same for all years. 5-year life, that computation is the same all 5 years. We don't have to redo step one. But step two was take that number, depreciation per unit, and multiply it by actual units for that period of time. Okay? And even if it's a partial year, it doesn't matter because that by its nature will adjust for that partial time. Because even if you're planning to drive it for 10,000 miles the first year, well, if you only had half a year, you'd only be driving it 5,000 miles. So by nature, you don't have to do the times half a year or whatever. Okay? All right. So now we're on declining balance. This was a little weird, and just like other things, I do it differently than the book. Who knew? You may use the book's way. I know how to do the book's way. Okay? And if you've learned accounting before, you've probably learned it the book's way. But if you do, then you're learning 3 totally different methods. For me, it's easier for me to say, how are these, to memorize it, how are these formulas the same and how are they different? Well, the way the first 2 are different, the first 2 are the same with the same numerator, right? But they're different in that the denominator is different, useful life for one, estimated units of production for the other, and they're different in that you've got a second computation for the units of production. So far, so good. So the way I do declining balance, by the way, it's often called double declining balance. It can be limited declining balance, but if you see the word declining, it's this method. Don't let the test or the quiz fool you. There's only 3 methods. One of them is going to say units, one of them is going to say straight line, and one of them is going to say something with declining. So don't say, oh, we never learned that one. Yes, you did. There's only 3, okay? Whatever they call it, and the most common is declining balance method. The next most common is double declining balance, and I'll show you why it's double, okay? So this one, you do start with the capitalized cost that we've already talked through and beat that little dead horse to death, okay? Cost, but it is not minus salvage. This is where our first difference is. It's minus accumulated depreciation at the beginning of the year. What does that mean? Well, you remember that accumulated depreciation is what kind of account? Contra asset. So whatever we have at the end of one year is the beginning of the next year, right? It grows and grows and grows and grows, and the book value shrinks and shrinks and shrinks and shrinks. Yes? And so this number will change every year. So far, so good. Also, in year 1, there was not a previous year, so this will always be 0. In year 1, it's 0. Always. And I don't say always very often. Right? Always. So year 1, accumulated depreciation at the end of the year, nothing. Okay? Year 2, it will be the amount of year 1. Year 3, it'll be the sum of years 1 and 2. Okay? Are you with me? So you would have to, if I asked you for year 3's depreciation under this method, you'd have to do year 1 and year 2 to be able to do year 3. So far, so good. So this is a different method in a lot of ways. The book tells you to multiply it by twice the straight line rate. So straight line, 5 years would be 20%. And they double that, so it would be 40%. I can do that, but I like this way better. I like to divide it by useful life and multiply that whole thing times 2. There's the double of your double declining balance. Twice the straight line rate, 2. This is a static number. That doesn't change. Every year we multiply it by 2. This doesn't change. Your cost is your cost is your cost. This doesn't change. Your useful life is estimated at the beginning, and it doesn't change. The only thing that changes every year is that number. Okay? And on the first 2, that number was static. Remember, it was salvage or residual or scrap. And that never changed. But this one does change every year. Are we good so far? Okay. So, let's do the one in the book, then we'll do a brief exercise, then we'll do another exercise.
So that was your way? That was not the book's way? That's your way?
This is Clements' way. The reason I like this is because it looks exactly like your straight line, except you have that instead of salvage, and you add the 2. So to me, it's easier to memorize this, but that's just me. Nobody asked me.
What is BOY stand?
Beginning of year. Beginning of year. Okay? We good so far? So let's go to page 550 something. 557. Remember this truck that they were doing, right? Did we do that? Did we do this? Did I use the truck? Maybe I did, maybe I didn't. Cost minus salvage was $40,000. By the way, do you see salvage value in there anywhere? No. And so even though the salvage value is not in the computation, we don't disregard it. We don't ignore it. What is the objective of depreciation? What is our main objective?
The real value of it.
We want to, okay, it's not fair market value, so, but what do we want to do with our depreciation expense, accumulated depreciation? What is our goal? What's the goal?
Make the book value equal the residual value?
Yes, we want to depreciate and put some piece of that depreciable base, in this case 40,000, into each of the useful years, 5. You with me so far? Okay? So when we get, even in this method, when we get to $40,000 accumulated depreciation, we just stop. And we want it all to be done in 5 years. Mathematically, this would never go to 0. Okay? You would have, in year 73, you'd have 12 cents of depreciation. And the next year you'd have 9 cents of, you see what I'm saying? Mathematically, it would never go to 0. But that's not our goal. Our goal is to put, in this case, $40,000 into 5 years in a rational way. So far, so good. So look what they did on your double declining balance, page 561. By the way, I don't even like that schedule. You may have one for homework like that. I just don't like it. And they do twice the straight line rate. 1/5 is 20%. 2 times 20% is 40%, right? I would do, notice that it's not 40,000, it's 41,000. Do you see that difference here? It's not cost minus salvage, it's cost. Okay? And in year 1, it's cost, 41,000 minus 0. So mine would be 41, year 1, minus 0 divided by 5 times 2. I would get the same number they got, which is 16,400. Are we good? Mathematically, you can do this. Okay? Make sure you do your subtraction first always, then your division, then your multiplication. Do it in that order on your calculator. notice year 2. Look at year 2. They did not use 41,000 as their first number because it's in year 2, it's 41,000 minus 16,400 divided by 5 times 2. The only thing I changed was that number. But I do the math again. And I get 9840. Okay, so now my accumulated depreciation in the first year, I debited depreciation expense, I credited accumulated depreciation 16,400. Right? And it's there at the beginning of the next year. So this would be accumulated depreciation for all prior years, is another way you could say that. But in year 2, that's the balance at the beginning of the year. Year 1's done. But now I'm doing another 9840, so I'm up to 26,240. You with me? Have I gotten to 40,000 yet? Because that's my goal. My goal is to put 40,000 in that account in 5 years. Do you follow? I'm going to say that again. My goal is to put $40,000 in 5 pieces in 5 years. Okay? Take the depreciable base, 40,000, 41 minus 1, right? And put it into 5 years. The periods used, the useful life. So, in year 3, I changed this again. It's not the 9840. It's not last year's. It's the accumulated. So what did I say it was? 26,240. And when I do that, I get 5904. Okay. You with me? And that's my amount. Debit depreciation expense, credit cumulative depreciation, 5904. And at the end of each year, I ask myself, are we up to 40,000? And the answer is no, not yet. Okay? So, I keep going. You with me? Any questions so far? All right. So now, whatever that is, somebody do that for me, please. 26,240 plus 5904, because I don't think they do it for me. 144? Okay. And so when I do that, I get 3542. So far so good. And I make that journal entry. Am I at 40,000? I say no. The next year, it's going to be smaller. You see how this is called an accelerated method. I will tell you the rationale, and then I'll tell you again. The rationale is, if you've ever had a brand new car, you know it's the most efficient the day you get it, other than getting the quirky little warranty things out of the way, right? It's the most efficient, and that goes for machinery and furniture and everything. And so the repairs are 0. And so part of the rationale is it's more efficient, so it should get a higher chunk of depreciation in the early years. The other is, if you mix the depreciation plus repairs, because if you've ever had an old car, which many of you might have, a junker that you're going to get rid of when you graduate, right? And if you've ever had an old car, you know that the repairs are significant, okay? So a lot of depreciation with a little bit of repairs, and in the end, a little bit of depreciation with a lot of repairs kind of smooths out the total expenses. Does that make sense? So that's another piece of the rationale, is that that's why we have accelerated methods. We can put more into the early years, less into the last years. But our goal, remember, was what? To get $40,000 into 5 years. So you know that this is going to go down if we do this computation again. But our goal is to finish it out. So they did not do this for the 5th year. What they did was they figured, I want 40,000 there. What do I need to get there? And that amount is 4,314. And that's year 5. Does that make sense to you? We're finishing it out.
when do you know, like, when to stop?
In the last year. Now, there are two ways to do this, and the book is doing it this way. And it is kind of creepy because this is bigger than that. Okay? It's kind of weird. There's another way to do it, but this is the way the book's doing it, and this is the way you'll be tested. Okay? Just finish it out. Finish it out. In real life, what typically happens is, for when it got to this point, we would compute that number and we'd say, well, how many dollars do we have left to get to 40,000? And divide it by 2, and it would have been bigger. These two numbers equal $7,856. And if I divided that by 2, I would get that number. And I know I've got 2 years left. So this is called, I could have done 3928 and 3928 and finished it out. And that's really what happens mostly in real life. Okay? If that makes sense to you. Right? And so that's called double declining balance with a switch to straight line at the end of the life. Because you're taking the remaining dollars you want to go into accumulated depreciation, the remainder to get to 40,000, and dividing it by. So whenever that's bigger than this, you could switch to straight line. And if that happened in year 5 and it was an 8-year life, then in year 5, 6, 7, and 8 it'd be the same amounts. And it wouldn't happen in 5. It would probably happen in year 6 or 7, depending on how big the salvage value is. Okay, mathematically. But you understand, salvage is not in there anywhere, but it is in there. Okay, we're going to stop depreciating this at $40,000. We're going to quit. Because our goal is $40,000 in 5 years. In one of 3 ways. Straight line, units of production, or double declining balance. So far, so good. Andrew?
What happens if the company say it's like a truck that they depreciated and then it's still useful? Do they?
It just stays on the books. It's called fully depreciated.
Okay.
You know, I mean, maybe if they're going to keep it,
Yeah.
maybe the salvage value would change.
Yeah.
You know, it's the sweetest dream we've ever had.
Yeah.
So we're going to, instead of 5 years, we're going to keep it 7. And so they might change the salvage value. And I am not holding this class responsible for what if we change our estimates. What if we change that? What if we decide we only want to keep it 3 years, but the salvage value is $5,000? There's accounting to do that, but you're not responsible for that. You will be in the next class, okay, in 3111. Not in the second class, but the third accounting class, okay? So we will do change in estimate then. You could change the useful life, you can change the salvage value, okay? And I'm not going to hold you responsible for that right now. But what I do want is for you to know how to compute it and to stop when you get to $40,000. So what would happen is if the salvage value would still remain at 1,000 and we're not through using it, we just wouldn't have any depreciation until we sold it for $1,000. It just stay on books. As long as we make this number, this estimate, and the $1,000 in good faith, using the best information we have, and we didn't make an error in those numbers, we don't have to correct it. It is understood by users of the financial statements that depreciation requires estimates. We don't have a crystal ball that works. You see? We have to make a best guess. And, you know, typically we keep our trucks 5 years. This one is a lemon, we're only going to keep it 3. That one is a dream, we're going to keep it 8. No big deal. Okay? Is that answer your question?
Mm-hmm.
Okay. So, let's go back. We did brief exercises 3 and 4, but we didn't finish them, remember? We only did the first A and B. So let's go back to brief, let's chunk that up.